Hey guys, so welcome back to another PropertyLimBrothers webinar series. And if you currently own a HDB or perhaps your HDB is about to reach its MOP, maybe you're thinking about restructuring your portfolio in the sense that you are planning for an upgrade, then this webinar series is for you because this will be your ultimate guide in terms of HDB upgrading. We are really going to take you all the way from the start to the end. So if you've been asking yourself, hey, Caline, why should I upgrade? I'm already so comfortable with where I am, right? You're already in a HDB. Maybe right now you're already in a 4-room, 5-room, enough space, or you're already in an executive apartment as well. HDB prices have also seen a rise over the past few years, so why must I make the jump towards the condo segment? Or maybe you're asking, private can really make money or not, right? You also have heard horror stories whereby some projects didn't do too well, or maybe sometimes the private property didn't appreciate fast enough, or they are not able to sell their property in time as well. So isn't it risky? And in fact, if you are taking the jump towards the private sector, you'll realize that your monthly installment will easily double or triple compared to your HDB, just because the quantum right now is so much higher as well. And maybe you're asking, okay, I do plan to upgrade, but when should I do it? Should I time the market? Should I wait for maybe interest rates to come down? Or will property prices start to depreciate also, then I enter? So all these questions might be something that you've been asking yourself. Then stay tuned, we'll talk about this at the end as well. And maybe right now you are ready to upgrade, you want to take the step, but you do not know where to start. Then we'll take you through our entire PLB 5-step blueprint as to how you should completely upgrade yourself from your HDB towards the private sector. So of course, just a quick disclaimer here as well, we take every measure that we can to provide you with the best information based on our experience, based on our team research, as well as all the frameworks that we have. But of course, please do your own due diligence as well to ensure that you make the best informed decision for you and your family. And a very quick introduction. So all our webinar styles here are completely unbiased in the sense that there is no pushing of any project. So we are not representing any sort of developer here. We are not pushing for any new launch or a particular listing. Everything done here is purely based on an educational point of view. So let's say today we are representing you as a buyer, then we are coming in as a buyer lens. And of course, if we are positioning you to help you sell your current property, then we are coming in as an unbiased seller lens as well. So really what we are taking here is more of an educational approach based on research as well as a lot of frameworks that we have here in PropertyLimBrothers. And for those of you, maybe it's your first time seeing us, so PropertyLimBrothers is a powerhouse in the sense that we have two teams combined. We have the media arm as well as the realty arm. So we help a lot of homeowners exit their properties. So if you want to check out some of the content, you can head on to our main YouTube channel. We also have Insights, where it's more educational series, as well as NOTG. This is a really fun channel where we talk more candidly about the hot topics, let's say on like property prices. We also have guest speakers talking about like businesses, finances, as well as relationships. So do check out all these channels if you like. So as mentioned, we are two arms combined together. We have the media arm as well as the realty arm. And just last year itself, we have helped more than 877 families with their entire real estate journey. And we have done about 1.05 billion in terms of quantum. And just a quick introduction to myself also. My name is Caline Leong. I'm an associate senior consultant with PropertyLimBrothers. So real estate is my first love job. Right after uni, I jumped right into real estate, never left the industry. So right now, this is my 8th year in. And my passion is really helping homeowners, especially HDB owners, sort of restructure their portfolio, sell their HDB, plan what's next for them as well. So these are just some of like the testimonial videos that we have also on our channels in our chit-chat session. So very quickly, let's just dive right into today's webinar. So typically, if let's say today you currently own a HDB, I think in Singapore, there are just main two routes that you can take. First, let's take a look at Family A. So Family A, right now, maybe they own a 4-room, 5-room HDB. It can even be a 3-room or basically any form of HDB. They plan to keep the HDB all the way until they retire. And of course, by the time they retire, let's say whether it's 55, 65, by age 65, no matter what, you will have fully paid the loan, right? Because HDB loan only allows you to loan up to age 65. Usually in this route, it's pretty much no stress, very low money installment in terms of your monthly commitment. So this is typically how Family A journey will look like. Let's say, maybe 26, 27, you just got engaged, you get married, and then you apply for your BTO. You wait for it to build, so maybe 30, 31, you collect your keys to your BTO, very exciting. Most of the time, if you have gone for the BTO route, you will have entered at a, not say a discount, but you've entered at a good rate, right? So maybe let's say you got something at 450K. In today's market, fast forward, right now, if let's say you're 35, 36, so HDB has just met its MOP. If you do plan to sell, likelihood you have already seen quite a huge profit gain. So even if let's say today in Pongo, 4-room HDBs are already going for about $800,000 for something that's pretty new. So if you continue to stay put all the way, just continue to pay your monthly installment, and in fact, if you don't sell, your monthly installment is going to be extremely affordable, just at 1,500 per month, because you only bought in at 450K. So even though your property price have already appreciated to 800K, you are only paying the installment based on this amount. So this would be pretty much very no stress, because if both you and your partner has been working, you guys have CPF OA, that's going to contribute to your monthly installment as well. I would think that there's almost like no cash top up that is needed in this entire route. By age 65, fully paid, let's say if the property didn't appreciate, you have another 800K to cash back down. So whether you want to retire, whether you want to sell, downsize, then this is the amount that you will have to retire with. Then on the other hand, we have Family B, right? So Family B are your HDB upgraders. They have the aspirations to upgrade. And in fact, we have seen a lot more young families choosing this route. And that's also proven by all the data, because we have seen home ownership for HDB dropping below 80% in the past few years. So all along before that, home ownership for HDB has been extremely high. It has always been above the 80% mark. But right now, the trend has been moving towards the private sector as well. So that's also where we see the trend going. So let's also dive into why Family B, or rather all these HDB homeowners, have this aspiration. And when they are choosing this route, what you'll note is that they will also have fully paid their next property by age 65, because that's where the loan tenure ends, but they are willing to commit themselves to a much higher monthly installment. So this is how Family B, potentially the portfolio, can look like. So same thing, you guys, MOP at 35 years old, 36 years old, you have made an 800K sort of paper gains, not say paper gains, sorry, 800K will be your next property value at the point that you want to sell. So you can extract all those cash equity that is trapped inside, sell it off, take the profits and reinvest into a private property. Let's say if you go for a 3-bedroom or 4-bedroom in the OCR region, you go in at something about $1.8 million. Then that's also going to be fully paid by age 65. And what I notice, of course, the moment you buy something at $1.8 million, instantly your monthly installment is going to 2x or 3x just now, Family A route. So this is about $5,300 per month, assuming an interest rate of 2.5% across the next 30 years or so. So why does Family B want to do this? The very first and most straightforward answer is really because of this angle. So what Family B is trying to do here is that when they want to retire at age 65, they're going to have $1.8 million in terms of asset value to split and downsize instead of just now Family 8 route at 800K. Right? So this is also how you can use property as a form of like forced savings, as a form of wealth accumulation to build your retirement portfolio as well. So right now in this end stage, they have maybe 1.8. They can go and buy a 1 million, EA, EM, renovate, stay very comfortably for their retirement, and then keep the 800K for their own cash as well. And in fact, for Family B, they have multiple options when the moment they are HDB MOP. They can either choose to do these few routes, right? So maybe let's say they have the strong finances, they have enough income, they have enough cash savings at all. They can actually go and upgrade themselves into one large condo or maybe even one landed, if that allows them. Or they can also do 2 routes in the sense that they can split their names. One partner buys the condo, another partner buys a second condo, or maybe it can be 1 condo, 1 landed each. It really depends on the structure as well. Or in fact, if the structuring was done right, so a quick disclaimer, you can keep your HDB and buy the next private property. Either you pay ABSD, or if you have done the structuring right from the start, you can actually buy it without ABSD as well. So these are the 3 key options that most families will have if they are planning to upgrade. And of course, in each of this scenario, there's pros and cons. It really boils down to your finances. It also really boils down to your comfort. But because each different routes have like different pros and cons. So for example, right, if you are going for like 1 large condo or 1 landed, of course, that's going to give you a lot more space. But when you're doing this route, that also means that likelihood you will not be able to rent out any portion of it, so the monthly installment will be fully covered by yourselves. Whereas in the second route, if you are going for the 2 properties route, 1 property can be for own stay, the other property can be rented out, so that's going to cover quite a fair bit of your expenses, thereby decreasing your monthly outlay as well. We can see more families are moving towards the private sector as mentioned just now. So if you take a look very quickly, this red bar basically represents condos and other apartments. So you can see like over the years, the red bar has been increasing, showing us that Singaporeans now are moving a lot more towards the private sector. The blue bars, be it whatever gradient, are all HDB properties. They are actually decreasing chart instead. So HDB dwellings, there has dropped, it's already about 77% just in 2023. Right now we're already in 2025, it has continued to dip a little bit as well. And there has been growing interest in the private property segment instead. And I think this is also a very interesting fact. So we've also done a deeper search and to see who are these people upgrading. What you'll notice, the younger generations are actually the one that are moving towards the private sector right now. So you can see 25 and below is increasing also in terms of percentage, almost a 1% increase per year. And of course, the most common pool is we have that is between the 26 to 35 years, as well as the 35 to 45 years, because that's when most people have income, and that's our income producing years to make the switch as well. And you might be asking, like, is the property prices moving too fast? Singapore can sustain or not? Whether the bubble will burst, right? So if you take a look at Singapore unemployment rate, it's still pretty healthy. In fact, we are still at all-time low, about 2.9%. So that pretty much has not changed in the past like 10 years. So I think in terms of a level of health, it's still very safe as well. And you might be asking, will more cooling measures come? We have seen already, 15, 16 rounds of cooling measures, but this is how Singapore property prices are looking still. So if you take a look at this chart, despite like 15, 16 rounds of cooling measures, right now here in year 2024, you still see a gradual upward climb in terms of property prices. So why do people love to park their funds into property prices? It's really because this is a very safe asset in the sense that it has a very strong holding power. It's illiquid, it's not like stocks, it's not like bonds. It moves a little bit slower, of course, compared to stocks and bonds, but if you do the right selection, it can help to accelerate your portfolio very, very quickly as well. So these are the 16 rounds of cooling measures that have been implemented. Feel free to have a look. But I just want to highlight that it's really good that Singapore comes up with cooling measures as well, because if without cooling measures, the property prices will just boom up so fast that maybe the next generation really cannot keep up. And of course, when that happens, that also means that it's going to present a bubble chart issue in the sense that maybe the prices climb too high, people cannot afford, then that's when we're going to have a serious issue of maybe fires in the future. But right now, because with all these cooling measures, and I really love the fact that TDSR in 2013 was introduced, because that's going to allow and ensure that every Singaporean are not borrowing like over what they can afford. So there's lesser speculation in the market. Most people, in fact, own homes for their own stay. 90% in Singapore, homes are owned for their own stay, not for investment as well. So let's come back to family B and understand they are paying more monthly outlay, but what is the main intent of this? Why are they willing to pay more monthly installment each month as well? So of course, first of all, they are looking for a lifestyle upgrade. They want to have more facilities, better facilities for their loved ones as well. But I think most importantly, what everyone in Singapore is trying to do, whether you're an investor in property, whether you're invested in stocks or bonds as well, we kind of all want to beat this. So this is Singapore's CPI inflation. Year 2024, we had a 2.8% in terms of our inflation rate. But if you go and deep dive into the numbers here, right, of course, this 2.8% does not include property prices. It also does not include like car COE and all. I think if the government were to include that, it's going to be really high. It's going to be a bit too scary for everyone to accept. So of course, that's going to exclude those two baskets of goods. But let's take a look at where the property price growth has been in the past few years as well. So just a quick introduction. OCR Pongo, in the past 4 years, we have seen like 6 to 7% annum in terms of gains. 382K in terms of total quantum for someone who's owning a 1,002 odd square feet unit. Same if we take a look at OCR in Sembawang, so in the north side, 37% increase, 513K quantum. So that's in just the past 3 years. So that's about 10 to 11% per annum in terms of the growth rate for someone who's owning about 1,003 odd square feet. So that would give you like a 4 beta. And if we move towards like the central area or closer towards the central, RCR, Balestier, Toa Payoh region. So this is a beautiful freehold project. 34% increase, 750K in terms of quantum in the past 3 years, so 11% per annum growth. And of course, if this one here is Gem Residences, just right beside the Ori, one of the hottest launches as well. So 32% increase, 338K in terms of quantum gain just in the past 4 years. Once again, about 8% per annum in terms of growth. And very quickly, right, I just want to highlight a key difference here for you, and this is one framework for you to take away right now. If you take a look, these two projects, they are both RCR. This one did 34%, this one here did 32%. So in terms of percentage, it's just a 2% difference. But how come this quantum here at 338K is vastly different from 750K? Right, so the first thing that you can take away is because of the size. So this one, the unit sizes here are at 1,006 odd, and of course that's going to give you like a 3 beta sort of size. And if you move to this one here, it's 678 square feet, so this would give you a 2 beta. So size matters when you are choosing a property, because assuming every property moves in the same direction at the same percentage of growth, or even just like 100 PSF, right? This is purely because of math. So you take the size, you times the PSF, you get your quantum. So every bigger size that you get, same PSF increase is going to give you a much larger quantum. So that's also what we have seen in this case, right? So this one, 32 versus 34% increase, but in terms of quantum, this is 750K versus 338K. So by choosing for a larger property, usually you can accelerate your growth as well. But of course, please choose the right one, the right layout as well, because it doesn't mean that as long as you go for something that is bigger, you'll definitely make money. It still boils down to the right selection as well. Okay, so moving on, if we have taken a look in summary, CPI inflation is at 2.8%, but the property growth averagely is about 8% per annum in the last 3 to 4 years. So this also shows us that, through property, it can really be a form of wealth accumulation to beat the ever-rising costs here in Singapore. Singapore inflation is 2.8%, but if you've done the right selection, you can outperform inflation plus, in fact, profit from it as well. So let's take a look at one of the case studies that we have successfully helped our clients to plan as well. And why they also chosen like family B route is that they really wanted to do intentional planning for their future. They wanted to safeguard their entire family's retirement plans as well as for legacy planning. So we're going to show you how they have managed to use their property portfolio to elevate their entire retirement plan. So this is Daniel and family. So Daniel and family came to us many years back. We have already helped them go through this entire 5 transactions here as well. So we sold off their HDB at 500K. We brought them to buy a 4-bedder penthouse in the resale market previously. They bought at 1.3. We have exited at 1.65. Similarly, we used a wife name to buy investment properties. So she bought another 3-bedder, rented that out, bought it at 1M. We managed to exit at 1.55. And in fact, recently we have also liquidated this current property and bring them to buy a new launch at Park Town Residences. And of course, the husband name has been freed up to go and buy a landed previously as well for their own stay at 2.85. In today's market, right now, the valuation for the lender, of course, has appreciated much faster. It is already valued at $4.5 million. So let's take a look at how their entire journey looks like for this particular family. At age 35, this is where their portfolio was at. So at age 35, they had their $2.8 million landed. So let's just talk about the landed segment here only. We are excluding the wife's portion. 2.8, fast forward to today, 2025, property value has already increased to $4.5 million. Now, let's just assume, okay, maybe the property prices don't grow that fast, but we can beat inflation. So assuming inflation rate of about 2%, so let's take a 2% growth per year all the way until Daniel reaches age 65. He would have a total value asset of $6.5 million at the end of this. And with $6.5 million, by then, because he would have fully paid off his loan, his mortgage would be zero, and then he can take this entire $6.5 million and plan for his retirement. So this is something that it will look like for him. By the time he's age 65, asset income, which is his house, will have $6.5 million. He can then choose to re-diversify into however he likes. So very quickly, I'm just going to show you how usually Singapore income bracket looks like. So most people have these 3 buckets, right? So first is your active income. So active income, of course, is like your salary, or let's say you are self-employed, or let's say you are sole proprietor, then whatever sort of income that you generate for yourself is basically your working income, your active income. Second one would be the asset income. So of course, in asset income, we are talking about properties. So maybe things that you own, things that can be like your own property, it can be investment property, it can be factories, it can be commercial, it really depends on what you have bought into, so asset income. And the third one would be passive income. Right, so passive income is always great. If we can create more buckets of it, it's always very helpful. So passive income can be in the form of stocks, it can be in the form of like dividends, bonds, or it can even be an investment property generating you rental income every month. So of course, for active income, this is only present if you're actively working. And usually that's only happened maybe, let's say, between age 25 all the way up to 65, but I would say most people actually retire before 60. So most of the time, this would be your active income range, whereas your asset income is something that you continue to hold all the way until, you sort of move on in life or so. Yeah, and then passive income, it really depends on when you want to liquidate it or whether you continue to invest in it as well. So if we take a look at what Daniel is trying to do, is that he basically wants to do this once he reached age 65. So once he's 65, he has $6.5 million. He can pump into these 4 buckets, right? So first, he can go and invest back into stocks, in the bonds, and then get some passive income every month. He put $2 million there, 5% growth. He can even use another $2 million to buy something for his own stay. So this can be a condo, this can be a HDB, up to him. He can live very comfortably, renovate it to his own liking as well. And of course, he can have another 500k in terms of liquid freedom. He can keep it as cash, go for holidays, treat himself to nice buffets, go for spa. And the last one, of course, passive income. He can continue to buy one more property as long as they have like 2 names, or maybe they are using their kid's name. It really depends. Then this rental property can continue to yield them passive income also, let's say 5,000 per month. So at the end of the life stage, this is what it's going to look like. He would still have 4 million in terms of asset value. Passive income can be as high as 13,000 or even more. It really depends on how you structure this. And you still have liquid cash on hand to go and enjoy as well. So this is what we mean by intentional planning, because Daniel and his family has already planned right from the start. They want to leverage on property to build their wealth so that they can retire with something of a strong asset income and don't have to worry the moment that the active income has been deactivated as well. So in fact, they're going to have a freedom of choice, right? Because if let's say maybe touch wood lah, okay, maybe they lost their job. At age, 55, they are ready to downsize. They are done. They don't want to work anymore. They want to retire. They can also choose to liquidate at this point, right? Of course, right now, let's say if they are at age 55, 5.5 million would be the estimated sort of asset value. They will still have an outstanding loan of 880k. They have to pay that off first. They will be left with equity of 4.62 after they liquidated their landed home as well. Same thing, they will still have this amount to throw back into the 4 buckets and structure to however is comfortable for their family. But basically, you have the freedom of choice. As long as you're in the right kind of property portfolio that has accelerated, you can look exactly like Daniel and family to propel your entire portfolio towards the end, and then you can choose as to when you want to exit. But of course, if let's say we have gone back to like family A route and assuming that the HDB has appreciated, but of course, usually because the quantum is not as large as a private sector, in terms of the differences for you to retire, it might not be enough, right, to enjoy that kind of returns at the end. So really, this is more for retirement planning, and I think a lot of people right now, we are also planning for the next generation. We want to ensure that our next generation has been well taken care of, and what we have also mentioned is the freedom of choice. So with the right selection of property, you can definitely outperform inflation, and in fact, it's going to allow you for a great form of wealth accumulation as well. So this is probably what family B looks like once again. And even if let's say you are not as ambitious as Daniel and family, you don't plan to move into a lender, you can always just do one switch and then end up with a slightly higher quantum at the end. Also, there's no right or wrong. It really depends on your own family portfolio. So similarly, if let's say you guys plan to just use one collective combined names to buy one property, you don't plan to do the 2 property route, that's also fine, right? That's really depending on your own choice. Then your property portfolio can look something like that as well, all the way until you're age 53, and you can maybe flip every 5 years depending whether the time is right as well. Similarly, let's say at the end stage, when you want to retire 53, these are the kind of income or these are the kind of brackets that you can have as well. Alright, so coming back to the same question, but isn't my monthly installment still higher? So why do I want to do that? Now let's take a look at what really goes behind your monthly installment. What is the real breakdown? So in every monthly installment, there are 2 main components. One, it will be your interest. The second one would be your principal. So first of all, of course, principal is your core. Principal is the amount that you're going to receive back after you have, sort of fully paid off the loan or the moment you sell off your property as well. Whereas interest, it will definitely be a pure expense, right? That's going towards the bank as a cost of borrowing from them. So if we come back to family A, so family A, if you remember, very affordable monthly installment. If they bought something at 450k, now let's assume every scenario here is going to be a 2.5% across the next 25 years for easy comparison. So if let's say they bought something at 450k, the loan amount will be about 337k. Monthly installment about 1,005. Every month, a portion goes to their principal. Every month, a portion goes to the interest. So sometimes you can see, especially in the start, your interest is almost on par as your principal, especially in a higher interest rate. It's just because normally for your interest, it's reducing due to the outstanding balance as well. So if we move on, 450k, if we take the annual interest in 1 year, they will have paid about 8,003 just on the first year, divided by the property value of 450k, that's going to take about 1.85%. So that also means the financing cost, or rather the interest, is going to cost them about 1.85% of their property value. Same, let's move to family B. So remember, for family B, they decided to upgrade, they decided to put themselves in a higher quantum asset value. $1.8 million, same, 2.5%. Their monthly installment is going to be about 6,000 odd. If we take a look at their annual interest, 33,000. So immediately from a quantum point, it's extremely much higher compared to families A1. But same thing, if we take it divided by the property value, it's actually going to give us back the same sort of percentage, so only at 1.85%. And even if you take a look, if you have gone into a lender, let's say $5 million, will the numbers look different? So same, 5 million, 2.5%, 16,000 in terms of your monthly installment, annual interest now jumps all the way up to 92,000. But if we take it divided by your property value, it's just at 1.85% again. So what I'm trying to say here is that it doesn't matter whether you're going to a $450K property, $1.8 million property, or $5 million property. Your expenses in terms of your interest is really just a proportion to the property value that you own, right? So basically you are still paying the same kind of interest, whether you're buying something of a smaller quantum or something that is bigger quantum. It's just because this is just a direct proportion to the property value. So in fact, if you take a look at the monthly installment, especially as your capital, this can be a very good form of forced savings. It's almost like an average dollar cost effect. Every month you just continue to pay your monthly installment. You don't have to think too much. Continue to do it as a form of average dollar costing. And if you have chosen the right property, at the end you will be very happy with your returns as well. And we can also see how property allows a family to 2x their portfolio. So if you take a look at this chart, let's say you started off with just a 500K sort of quantum, right? 25% down payment is the minimum, so 125K, you take up the full 75% loan. Principal paid in the first 5 years will be 62,500. We assume just a capital gain of 2.5% increase every year. So that's going to be about 12,500 in terms of your pricing gains. And for your capital gains, that will be at 62,500 over the 5 years. So if you take your principal plus your capital, it will be 125K that you have gained. But of course, not forgetting to add back the initial down payment that you have put in also after you sold off your place, because that's something you're going to get. That's something that you're going to get back. So you're going to get back 250K, and we can use now this 250K to re-put into cycle 2. So right now, cycle 2, you can move up towards a 2x property. This is $1 million. 25% down payment needed is just 250K. So and so forth. You can see by the end of this stage, they are going to get 500K in terms of their total capitals plus principal paid. So they can now use this 500K to pump it back into a $2 million property for the 25% down payment. So this is really how you can 2x your property portfolio every single cycle. But of course, the caveat here is that you have to be continuously working. You should be able to finance it, enough income, able to take up the loan as well. Then this is how you can use property to 2x your portfolio almost every cycle. So of course, it will only be wasted, if let's say you have the ability to do something about your portfolio, but you decided not to. Maybe you're just trying to time the market, or maybe you're just unsure. Do speak to maybe some of our consultants here as well. They can probably give you a better insight. But I think that the opportunity will be highly wasted, if we knew that we could have been earning this like 10%, 11% per annum sort of return, but we just choose not to do anything about it. Alright, so of course, we also want to understand where your life stage is at, because every life stage is different. So that's also going to take us through different kind of journeys. So if you are working, and just like what we mentioned, you want to use property to 2x your value every time, we are probably still in the growth stage. And of course, to be in the growth stage, you should be working. You have income producing years as well. Before we move into the consolidation stage, so maybe at this stage, we are planning for retirement already. We do not want to take any more loan. We don't want to take any more risk. We are planning for consolidation before we go into the decumulation stage, which means your retirement stage. We go downsize everything back down as well. So to loan, income is needed. So if we take a look at this kind of life stage, your income producing years are extremely precious. Because the younger you start, you have more runway ahead for you. But the later you start, of course, the number of cycles that you can probably do, it will be lesser. So it really depends on your life stage as well. So like what we mentioned just now, there's 3 main income buckets as well. Your active income, asset income, as well as your passive income. We have it very strong when we are working, when we are younger. And of course, the moment that we reach retirement, of course, this is probably going to be X'd out already. We will just leave these 2 buckets. So now let's come to this. So at PropertyLimBrothers, we have also helped to categorize, everyone's life stage into 4 main seasons. So we have spring and summer. So spring, usually you're younger, 25 to 35. It's your longest season for investing because you have a very long runway ahead for you. Your commitment likelihood is still very low. Maybe you just got married, but you are already starting to build your portfolio. So summer is your highest income earning power. Usually you guys are aged about 35 to 45 years. You can then continue to use your property to increase your entire portfolio. Autumn and winter is what we talk about, like the consolidation stage as well. Here we are not so aggressive anymore. Maybe we want to do one last move in terms of our investing journey, or maybe by the time here we are already done, then we do not touch this. We straight go into winter, where we have a defensive stage planning. Basically, we are planning for retirement here. So we really want to focus on spring and summer, because spring and summer are your income producing years. So we want to see how we can leverage on life stage investing together with your income producing years to make the best out of your property portfolio as well. So some things to take note as well. Even if, let's say, you're earning the same amount, right? So let's say you have an income of 10K. if you have started at age 35 versus if you have started at age 45, it's going to make a difference in terms of your loan capabilities. So that's also what we mean by do not waste your income producing years. If you take a look at age 35, with the same kind of income, you can loan about $1.1 million odd, but the moment you come to age 45, because it's 10 years later, your loan is going to drop to 892K. So that also means that in terms of maybe your property portfolio asset value is going to be limited by the amount of loan here as well. Similarly, even if let's say you can take the same amount of loan, but because you have started later, your loan tenure, because it has now dropped by 10 years, your monthly installment is going to be much higher versus something that you can take at 30 years. So that's also something that we want to be mindful of, and to ensure we can kickstart our journey a little bit stronger, a little bit earlier, just so that we can future-proof it as well. So basically through the right property portfolio planning, you can really have more freedom of choice towards on how you want to exit and when you want to downsize in the future. So this, coming back once again to this chart, this is probably what it could look like if you have done the right planning from the start. And I think that everyone is control of their potential future. As long as we have done the due diligence as well, we can have that property portfolio that we aspire to do. Alright, so you might be now asking then, okay, maybe I just want to keep my HDB, low commitment, I don't need to stress so much, don't need to think about moving, don't need to think about upgrading, I just park the rest of my money into a fixed D. How about that? Would that work also? Would that also bring me like the same kind of returns as property? So first of all, let's understand the main difference between property as well as stocks, or whereas like dividends and all. So I think the beauty about property is that it has the utility value. So this is my favorite thing about property, is that property is something that you can loan from the banks. At the same time, they allow you to stay inside. You can use it whether you want to rent it out, whether it's for your own occupation. You can have that utility value. You can physically go inside. Whereas on the other hand, for stocks, of course, that's purely just a financial investment. There is no utility value for that. I mean, there's nothing that you can physically do with it. It's just all a numbers sort of property, numbers sort of portfolio on that hand. And for property, it's definitely more illiquid. It's not something that you say, hey, I want to sell. 1 second you can sell. No. For stocks, it's something that you can do, through our apps, through a touch of our finger, we can sell the stocks already. So this is very liquid, whereas this is very illiquid. So that's one of the strongest key difference as well. So let's just take a look at another case study here that we have as well. So recently, I think just in 2023, I've helped this family. Let's call them JMP family. They own a HDB at Compassville Crescent. Very comfortable. It's a 5-room. They were comfortable in size. It was not really upgrading for more size, but basically they already had the intention to future-proof their retirement plans also through property. So when they came to us, they were thinking whether they should buy one big one or whether they should go and buy 2 properties under one name each. Right, so I think after much calculations and all, our path for them was to go and buy one each because they have the capabilities to do so. So basically, we sold off their 5-room flat in Compassville for $772K back in November 2023. Pretty decisive. You can see in 2023 December, just 1 month later, we have managed to secure their 4-bedder at Rivervale Crest for their own stay. So of course, we told them to please first secure this first, right? The own stay needs always come first before the investment, because this is a house, this is a family home. You still need somewhere comfortable to stay. So we have ensured that their own stay needs were first met before we move into the investment property. So in fact, you can see that we took almost 9 months later in September 2024 before we have formally went up to offer and secure a unit for investment. So we bought a 2-bedder for investment at the Brownstone. So the Brownstone is at Canberra, bought at 1.135 back in year 2024. So both husband and wife are the same age. They are age 37. And you can see that through this split, right, why we ask them to do the 2 routes instead of owning one big one is really because they can decrease their cash flow quite significantly. So for the 2-bedder at Brownstone, it can fetch a rental about $3,500. Monthly installment for something that at 1.135 is going to be at $3,360, not factoring that she has CPF OA, especially if she's continuously working as well. So if she's going to use the CPF OA to finance, her monthly installment can be covered by that as well. But in this case, the rental, if it's at $3,500, is more than enough to cover her monthly installment. In fact, she will still have access as well. So in terms of Brownstone, this is already fully taken care of. If you come back to here, the 4-bedder at Rivervale Crest, they bought at $1.4 million. Monthly installment is about $4,149. Husband is also working. He also has CPF OA, so he can use his CPF OA to offset the monthly installment through this very intentional planning of doing 2 properties instead of one. Total asset value is 2.53. So technically, they could have bought a one big, maybe 4-bedder, $2.5 million in the RCR region, but they chose to do this 2 properties route instead. Own an asset value of $2.5 million. Cash flow per month is just this one here right now, because this one's already taken care of. So the cash flow here is about $4,149 per month. But don't forget, he still has CPF OA. So if I just assume that we're only using the husband's CPF 1380 per month, his monthly installment is just at about $2,800 per month to own a $2.5 million property portfolio. So this is one way, and the beauty of owning two properties. You can leverage on one to rent out, use the other one for own stay, increase your total asset value while still decreasing your monthly installment. So sometimes it's not about just buying like a bigger property value. It's really about doing the right structure and what works best for your family as well as your financial needs as well. Right? So I think this is a very comfortable plan for them still. And moving on, if I take a look, right, if let's say the wife didn't go on and buy brownstone, they kept the spare cash for their own use, maybe they go and pump into fixed D instead. Sorry, it's lagging a little bit. All right, let's take a look at this. So if we assume for brownstone is the investment property, right, it did not appreciate, okay? So let's assume the worst case scenario, the property price didn't appreciate, but they continue to rent it out. So if let's say they continue to rent it out, we will have about 175K in terms of rental income for over 5 years. And how do I get that number, right? I'm going to take, if let's say every month you can rent out 3,500, I'm just going to take times 10 instead of times 12. The reason why is because you still have to pay for like your property tax, your MCSE fees, maybe sometimes a little bit of downtime in terms of your rental handover also. So let's just take a 10-month conservative in terms of your total rental income per year. Will be like 35K per year, right? And then we take it times 5, 175K in the entire 5 years. Initial down payment that was put in was 313K plus together with your BSD. So if we take the total gains from just the rental income divided by your initial down payment, which is basically what you have put in from the start, you will see that that's a 55% growth over the past 5 years, 11% per annum. And that's of course very strong because you have the fact that you can leverage on property, take up the loan from the bank, but at the same time still rent out that property. And the good thing is that banks do not need to share your profits. They also don't share your rental income in the sense that the bank lend you X amount to go and own X amount of value, but whatever rental income that you're collecting, the banks do not need to know that, and in fact they don't collect any share of it as well. So that's one of the beauty of leveraging in terms of a property. And if we assume now the property prices have appreciated as we have seen over the years as well, just a conservative 3% per annum, at the end of 5 years, the total quantum gain in terms of a pricing appreciation would have been about 180K. Right? And if we add on the rental income at 175K, the total gains that they would have gotten would be at 355K. So same, we take that divided by your initial down payment of 313K, $750. You will see this is very staggering. This is 113% growth over the 5 years. Per annum, that's a 22% growth. So this is extremely good numbers, especially if you are coming from an investment point of view. But of course, if you can do something that outperforms this, by all means as well, right? So I think this is one of the safest way that a lot of Singaporeans are moving towards property, leverage on it to increase the entire portfolio. And in fact, even if let's say they can get something of a fixed D at 5% or 8%, they will still have made quite healthy gains as well, right? We can see that this would be the side-by-side sort of comparison. If they've gone for a fixed D, at 5%, 86K in terms of total quantum gains, or if it's something that is higher at 8%, 147K. But if you just compare based on the percentage point of view, it's very clear here that even if your property price don't appreciate, it will have given you about 11% per annum gains, of course through the right kind of property selection as well. If you can rent it out, plus your property has not appreciated, more likely than not it would have appreciated, it would have done you a 22% per annum gains. So compared to fixed D, I think that the property sort of portfolio here can really help to propel your journey here as well, right? So once again, coming back to the beauty of property is that you can use it for your own occupation, you can rent it out, you can collect income, but the banks still do not need to share your profit, right? So of course, versus stocks, that's very liquid. It really depends on whether the market is good or bad. Only in a good market would you want to liquidate your stocks as well. And I think we also mentioned this, that banks do not need to share your profit, even in a property price appreciation. Even let's say your property price right now has gone up to 400K, the banks also do not need to share that 400K sort of quantum gains that you have. You only need to pay back whatever principal and interest that is being owed to the banks. So let's move on to the next portion. Now let's see how some of the good selection of properties have performed in an uptrend fashion, especially in the past few years, and what are the kind of gains that you can enjoy through property investing. So this is the panorama. So for those who are not too familiar, this is in Ang Mo Kio. We love this chart. We love this kind of looking graphs because it's moving in an uptrend fashion. So panorama did extremely well up to date. So it completed back in like 2017. So right now it's already a resale property. You can see that up to today, right, 0 unprofitable transactions. What that means is that whether you bought it at launch or whether you bought it as a resale owner, second owner, third owner, you will have still seen gains, right? Because the entire project is still performing extremely well. And some of the biggest gains you can see is like $1 million. The top 20 in fact do at least 800K and above in terms of their profitability. Next one, Mera Prime next to Tiong Bahru MRT as well. Similarly, although this is not as steep in terms of the graph curve, it still did pretty well. So it's still an uptrend fashion. We also like this kind of graph. Same, you have 200 over profitable transactions, just only 2 unprofitable, but these 2 are very marginal, just 0. Somebody just sold back at the same price and one person made a 10K loss. So in terms of profitability, it's still extremely high. You can see that most of them are crossing above the $1 million mark in terms of profitability. Park Colonial, one of the newer projects in Woodleigh as well. Profitability, averagely at least 500K to $1 million depending on their price. Uptrend fashion as well. Same just across Park Colonial is Woodleigh Residences, integrated development, beautiful. It has also done an uptrend fashions. A lot of profitable transactions, also mostly crossing from 300 to 600K in terms of gains. So you can see that despite of the entry time, whether it was a new launch, whether it was a resale, homeowners still can make money through the right selection of properties as well. But then we really want to take a look. Does it mean that as long as you buy a private property near MRT, good facilities, good location, confirm will make money? So let's have a look at these properties here as well. So all these charts I'm going to show you, these projects are all within 5 to 7 minutes walk to MRT station. So they all have very excellent location. However, if you take a look at how they have performed, for this particular project in District 2, in terms of the PSF, is almost the same. 2003 in the start, 2003 at the end here. So in terms of a performance point of view, it's very flat, didn't appreciate. Similarly, this one, in fact, went up a little bit, came back down. He did a U-turn. For this one, same. He came back up a little bit and then it went back down. So they bought at 2.2. Right now, it's only valued about 2,000 odd PSF. And we move on, Sentosa Properties. I'm not going to share the exact project, but you can see 1,009 in the start. Right now, the valuation is only about 1,005 or in terms of the past transactions. So they took a hit as well. So these are like projects that didn't perform very well and they are existing in the market. So what I'm trying to show you here is that it doesn't mean that as long as you buy private, it confirm will make you money. It really boils down to the right selection of properties as well. You have to have a very good understanding as to where the market is moving towards, what's the kind of demand that is forming as well. We also want to take a look at new launches, right? So there's a lot of hype as to new launches. A lot of people say that, you should definitely buy new launch because nobody profit before. You'll be the first one to own it. You'll be the first one to make money. You should buy new launch. Right, so we also want to take a look whether new launches all make money. So of course, good selection of new launches can let you have this kind of outstanding gains also. So for example, this is in Park Esta. You can see there is a healthy trend upwards. Profitability is more than 600K up to $1 million odd dollars or so. That's Caline Residences. You also have like 500 over K to $1 million odd sort of profitability. Everyone made a good profit. 279 profitable transactions, 0 unprofitable transactions. So pretty good performance as well. Or on the other hand, you could look something like that. These are also new launches. TOP went to the resale market. Unfortunately, this one took a U-turn. It went down, so it didn't perform well. In fact, people are starting to lose money there. Same, this one here, it has continued to move up, but then it kind of stagnated a little bit. So in terms of profitability, it's pretty much the same. In fact, if you take a look at some of the unprofitable transactions, it can be as high as 339K. We have also seen condos that make a hit now that take a loss of more than $1 million as well. So I think this is also one very good example that a lot of people buy based on emotion, especially on like new launch hype, the new launch day, but they have not think very clearly in terms of their exit plan, and thereby the results does not perform as well as they hope. So this particular project is already completed right now, has already reached the resale market, sold out 70% on their launch weekend. So it did extremely well on their launch date. However, fast forward to today, you can see how it's performing is that it has basically taken a hit. It has came back down in terms of pricing. It's not doing very well. Even though right now there are 0 unprofitable transactions, if you take a look at the number of profitable transactions, there are only 16. So there are 2 telltale signs here. One is a very low transaction volume for the number of units that they have. Not many people are transacting. The demand presents to be weak in today's market. Profitability is also pretty much lukewarm. People are making gains from like 13,000 all the way up to a high of 380K. So that's about the margin that they are going for right now. So just now we have seen like $1 million, 500K, 600K. So this one, upper limit is about $300,000 only. And in fact, if you take a look at the number of listings for sale, so this is another key thing that we also want to take a look when we are planning to sell a particular property in the future. Do we have an exit audience? Because this one, 197 listings for sale. However, just now if you remember, only 16 were transacted, right? So the number of supply is extremely high, but the demand here is extremely weak. And in fact, if you take a look look at some of the listing prices, right, they are starting about $1 million, which is basically the price that they have bought into at launch as well. So most of the owners here, after they minus all their expenses, their buyer's stamp duty, the agency fees and all, likelihood they're going to end up either just a net zero or in fact a loss as well. And of course, let's take a look. We talked about location just now as well. We've already seen that it doesn't mean that if you buy near MRT, confirm make money. But I want to bring your attention to this also. So this is very interesting. This is Tanah Merah, for those of you who are not too familiar. Let's take a look at these two particular projects in comparison. So we have Casa Merah, it's an older project. We have Urban Vista right next to the MRT, it's a newer project. So side by side, almost in terms of location. Casa Merah, 99 years from 2006. Urban Vista, 99 years from 2012. Right, so obviously, Urban Vista here is the much newer project. So let's take a look at how this two has performed. So for Urban Vista, it's interesting. They came in like 2012, 2013, that era. Of course, they were hit by TDSR as well. So that's also why their property performance didn't do as well. Fast forward to today, only in like 2023 to 2025, did they then start to see gains. Did the owners then start to slowly see profits. That also means for anyone who had bought on launch, they will have to hold for more than 10 years before they started to see gains or started to break even. So this is also very evident here. You take a look at the number of profitable transactions versus the number of unprofitable transactions in their entire history. They have 97 unprofitable transactions. The losses are about 200K over, 100 over K. But in terms of profitable transactions, they are like maybe on a high, it's just on 530K, but averagely for the top 20 is only from 130K onwards. So it took a long time before Urban Vista owners managed to see some level of gains as well. Whereas if they have maybe considered the resale options back then, let's say at Casa Merah, despite it being like 6 years older, right, you can see that for Casa Merah, 509 profitable transactions, profit gains here are also did very well, 330K, 800K, $1.1 million, so 800 over K in terms of profitability, versus unprofitable transactions is just only at 26, right? So this also shows you that even within the same kind of enclave, it doesn't mean that as long as you buy that district, everything's going to perform well, right? It really boils down to the right selection also. So it also shows us it doesn't mean that if you buy a new launch, it will definitely make you more money than versus you have gone for a resale option in that market. And in fact, this one is one that did very well. So this is High Park Residences. It's completely not near the MRT, but in terms of profitability, to date it has done extremely well. 551 profitable transactions. Look at the amount of profitability here is extremely impressive. 780K all the way up to $1.2 million for something that's OCR, something that's not near any MRT, and when they first launched, no amenities, not much amenities, I'm not saying no amenities, but not much amenities in the area as well. And I think this is also one of the biggest myths, is that doesn't mean that if we just buy something with high rental yield can cover my monthly installment, that is a good investment. Right, so let's take a look at this. If I went on to search in the entire Singapore, what are some of the top performing rental yield projects, you can see that Kovan Grandeur is the number 4. So if I take Kovan Grandeur and I pull it back to where the entire Kovan area is, so they have this kind of projects in the area. You have like Park Vera, Kovan Residences as well. So their rental yield obviously is much lower than Kovan Grandeur. So Kovan Grandeur rental yield is at 5.2%. Kovan Residences as well as Park Vera is just about 2.9 to 3.5%. So rental yield, immediately these two projects do not perform as well as Kovan Grandeur. But however, in terms of a profitability standpoint or in terms of a sort of asset value standpoint, you can see that Kovan Residences and Park Vera has done slightly better than Kovan Grandeur. And same if we take a look at integrated projects, right? Assuming back in like 2020, someone with a budget of less than $1 million, they could have two options. They could have bought Watertown 2-bedder, integrated right with the MRT, your mall just downstairs, very convenient, 2-bedder at just about 988K. So fast forward to today, 2025, they will still have made gains. In fact, right now the prices have moved to about $1.45 million for something that's about 807 square feet. They will have seen a 462K in terms of quantum gains. On the other hand, if at that point, instead of going for something that's integrated near the MRT, they have now decided to move much further away from the MRT. They've gone to River Park. So River Park is a condo at the tail end of Punggol as well. If they have bought the resale options there for, let's say they could have gotten a 3-bedder at 1,000 square feet at that point. 980K, fast forward to today, is valued about or transacted already at $1.565 million. So that's going to give you a total quantum gain of 585K versus just now at 462K. So that also means that by going away away from the MRT, by going away from something that's not integrated, homeowners still can see an additional 123k gains. So it really boils down to the selection strategies here once again. Alright, so of course, if let's say you cannot choose the right property, as we have seen some of the property performance, then it might be better off for you to put your money in CPF or in fixed D as well, because that will have given you like guaranteed returns, and at least there are returns as well. So once again, property planning is very important. It doesn't mean that all kind of private properties will definitely make you money. It really boils down to the selection strategy as well. And I think a lot of times, a lot of people have this very common fear. Prices in Singapore are already very high. Do we still have room to grow or not? So we have already taken a look at this chart just now. We have seen that despite the number of cooling measures, property prices continue to grow. And one of the strongest reasons is because Singapore has a very strong sort of moat analysis around it, right? We have high ownership. 90% of our homeowners here all own the property for own stay. So it's very unlikely that people will fire sale, because if I have to fire sale, I still have to move to somewhere, and I still need to buy another property. So people would take a lot of time to consider whether it's worth putting their unit out for a fire sale. And most of the time right now, with like TDSR, MSR, all this kind of policies in place, ABSD as well, it has really dropped the number of speculators sort of investing in the market by quite a fair bit of amount. Most people have their own name, they only own one property, right? And I think most importantly, Singapore has this magic feature, is that we all have BTO rights. You can apply for BTO, and BTO are usually the ones that are helping to push the property prices up as well. Because most people start from BTO, they have seen a profit gain from there, they continue to upgrade into the private sector. Maybe they start with a 2-bedder, they move up to a 3-bedder, then 4-bedder, and then slowly towards the landed market. So that's usually how the pricing mechanism works in Singapore as well. And if we take a look at this, so this is a very important chart for you to take note. Purchasing power in Singapore versus the amount of debt that we have. So you can see with the introduction of TDSR in 2013, our debt owed to the amount of asset value that we have is significantly dropping already. So last time the market was speculative because there's not so much cooling measures in place, not enough regulations, not enough policies. But right now, ever since all these policies have been put in place, high ownership, you also can see that people do not over leverage. People have very strong holding power. And in fact, most of the time, Singaporeans at least hold their properties for 9 years before they make a flip. So it really isn't like stocks. It really isn't like the market last time, whereby let's say, today you want to sell, you can sell. It doesn't work like this anymore. So strong holding power, and we can see more family moving towards the private sector, as we showed just now as well. Now, I think what we really want to talk about in terms of pricing is to understand this key fundamentals here as well. So how does pricing works? So pricing, whether it's for a good, whether it's for a service, whether it's for anything, it really boils down to demand and supply. So this is pure economics here as well. So we take a look at the supply in terms of Singapore, right? So Singapore, this is how our housing supply looks like. 75% of it, of course, is going to belong to HDB. HDB is still our very core in terms of supply. We have about 1.2 million supply of HDB units, whereas on the other hand, for private homes, non-landed ECs, we have about 370k if you add like all the ECs in and all. Landed is the one that has been hovering about 73,000 to 74,000 in terms of supply in the past many years. It has not increased because there are no longer like land sales for landed anymore. In fact, most of the time, if you want to get another landed out now, it's really through subdivision of land. So landed in terms of scarcity is extremely high. Now, so we take a look at where the ownership is for private properties. Most of the time, it's still owned by Singaporeans. A lot of people have the misconception that, hey, is it all the PR and foreigners are buying up our private properties? So in fact, you can see through this chart as that majority of our homes are still owned by Singaporeans ourselves, so 80% and above. And now let's take a look on the other hand where the demand is coming in. So by 2030, not too far away, that's just about 5 years from today, Singapore has visions for the white paper population. We are estimated to grow to about 6.9 in terms of our population. And what that means is this. In 2030, if we take a look who can buy what kind of properties, it's going to look something like that. Singaporeans still take up the majority. Let's say we have about 3.5 million in terms of population. Yes, they can buy HDB, they can buy condo, they can buy landed. But why landed in terms of scarcity is extremely strong? Because only 73,000 in terms of supply, yet at the same time, only 3.5 million of Singaporeans, let's say 5% can afford this. So you take 5%, you times 3.5 million is still way more than the number of supply that we have here. So once again, if people have the demand, the supply is limited, the demand is more than supply. This is also why the pricing aspect for landed has been extremely strong. It's very resilient. People do not largely fire sale in this kind of categories. Coming back to condo, so condo is the one with a little bit more free play. You have more people who can buy in. So what that means is that now for condo, your demand is going to be extremely strong as well, because you're going to attract PR, you're going to attract foreigners. Of course, maybe maybe foreigners, not so much in today's market due to the ABSD, but you still have the most number of buyers available in this pool. So with a limited supply, once again, 340k, but a strong demand because so many people can buy into, this is also going to be another asset class that has been proven to be very strong. Does not really drop in terms of prices. People have strong holding power here. And of course, HDB most of the time is for Singaporeans, right? Largely reserved for Singaporeans here as well. In fact, I just asked ChatGPT just now, so what's the total population today in 2025? It's already at 5.7 million. So we are really not too far off from 6.9 million. If I come back and apply the concept of economics to this, basically we want to see the hardness of the asset type that you're moving in towards. We want to see the elasticity also in terms of pricing versus the supply. So like what I mentioned already, landed will always be your hardest asset because in terms of the percentage of supply, it's extremely low. At the same time, the number of people that is eligible here will still be higher than the demand. So this will be very, very inelastic in terms of its pricing. Coming back to condo, it's still a very hard asset as well because you have only just about 20% in terms of supply, but the demand is extremely strong in this one. And then if we move back to HDB, HDB has the most number of supply. So the higher number of supply, the more elastic, of course, your pricings are. And in fact, I think that's very evident through Singapore's way of governing as well. If you take a look for HDBs, right, the moment that the prices climb a little bit too fast, what government tries to do is to really step in and ensure that Singapore houses continue to be affordable. They will then continue to pump more HDB BTO into the market. So for example, in 2025 all the way to 2027, government is going to introduce more than 50,000 flats, so they're increasing the supply to meet the demand here, thereby controlling prices as well. In fact, they have also come out with the new kind of restrictions in terms of the not asset classes, but the type of houses in terms of BTO. You have like a standard, plus and prime. More restrictions, so you can see that something that is more elastic in terms of a segment is going to attract more government policies, more cooling measures to tighten that kind of segment first. Yeah, so this would be something that is new. If you guys did not know, for the HDB now, there's the plus and prime. It's going to be a 10 years MOP instead, so it's going to double up in terms of timing as well. And HDB continues to increase the supply just to meet the demand. So in terms of elasticity, in terms of an asset, coming back to this once again, a soft asset, so something that's more elastic. When the prices rise too quickly, just like the HDB segment has seen, supply is going to come in to increase as well to meet that kind of demand, suppressing the level of pricing growth. Right? Whereas if let's say the asset is extremely strong, extremely hard, it is inelastic, then when prices rise, you'll find that it's very hard to introduce more supply because there's just not enough land, no more space to give to it, and that's also why the prices in this particular segment will continue to grow a lot faster than prices in this segment here. Alright, so if you're in the season to invest, we always want to park our funds into something of a harder asset because that's going to help to safeguard your future as well. But then once again, coming back to your comfort, coming back to your own finances, and just let me show you another case study here. So for our family here, Mr. Gunn and his family, he was also a HDB owner, but he also decided to park his funds into a harder asset. So let's just see how their HDB has performed. If they have kept their HDB, right, they chose not to sell their HDB. We sold it at 710k back in 2022. Fast forward to 2025, HDB prices have also done pretty well. Let me just show you this. Right now in 2025, it is already sitting on a 90k paper gain, right? The prices have already moved up here as well. But because our owners, they were believers of moving their funds into a harder asset as well, and they also wanted a better lifestyle for their family, they decided to park their funds into a 5 beta at Sky Park Residences back then. So they sold their HDB, bought a 5 beta at $1.81 million. Fast forward to today, right, you can see that in less than 3 years, the transactions have also already moved up. The latest transaction done for this is already at $2.1 million for the same size unit. So they are already sitting on 290k gains in terms of total profit. So 290k versus the 90k of your HDB, you are still making an additional 200k gains in terms of your total quantum just by switching towards a HDB. So this is how Mr. Gunn and his family have done their property selection. They wanted to use the forced savings method, switch to a harder asset, go into the condo segment rather than keeping on to their HDB so that they can continue to leverage on property and make sure that their wealth accumulation is done correctly. Right, so if they didn't dare to make the jump, then they obviously in today's market will have lost the additional potential benefit of 200k. So similarly, this is for another case study. We also sold their Dawson HDB. So Dawson is a very prime location. They could have stayed here, go to work very easily because it's so central. But they've also decided to move away from the city and park their funds into a harder asset. So they actually went to buy a 3 beta at the Quartz. So the Quartz is just right beside Buangkok MRT station. We bought it at 1.32 back in 2021. And if for their HDB, right, if we sold it at 865k back in 2021 as well. And if let's say they continue to hold on to their HDB, technically in today's market, they have to make another 235k gains in 3.5 years. So this is extremely impressive also. The HDB prices have also climbed pretty high in the central areas. But let's come back to where their quartz is performing. So they have moved to OCR region, parked their funds into a condo in OCR region. Right now, they have already seen about 491k in terms of their total gains. So by parking their funds into a harder asset, by switching to, even though it's an OCR, they've gone to a condo, they have made an extra 256k gains. So you can see how this hardness of assets help to propel one's property portfolio as well as their total asset value. Alright, so now let's move on to the second part of this webinar, which is really our 5-step framework here at PropertyLimBrothers. So this is what every homeowner should be looking out for if you are ready to take this upgrading journey. These are the key 5 steps that you really want to have a very good understanding, and then you dive into it as well. So first of all is your direction. Step 2, your finances. Step 3, your timeline, when to sell, how to sell first, buy first. Step 4, very exciting, is the micro selection strategies. And of course, last one would then be, after you have understand all these 4 steps, then you go and offer up the right unit at the right price and secure the home for yourself, right? So let's take a quick dive into all this, because we will do a separate webinar to slowly deep dive into everything here as well. All right, so step 1, direction. I think it's very important for every family to have clarity on their goals. You should really discuss with your partner, with your family members, what are the key needs? Why are you guys upgrading? What are the main objectives? Is it really purely for investment, or whether it's something that's more for lifestyle, whether it's more for own stay? So those are things that you guys should have clarity on. Discuss it with your family as well. So understand all these key factors. We also always want to understand your holding period. How long do you plan to hold this for? 5 years? 10 years? Do we need this address for primary school? Or do we need to shift even before primary school? Then maybe that's going to change the entire holding period. So these are key questions to ask yourself as well. Needs analysis, we'll leave it to you, discuss this with your own family. You know, what are certain things that you all need? Floor level, layout, bedrooms, bathrooms. Do we need more space? Are we okay to go smaller space? State of condition, do we need something that's renovated, or do we prefer to renovate the space to ourselves? So these are things that you can ask yourself. Of course, combining with the fact that you need to understand your financial range, which is towards the second step as well. And I think if you're completely coming in from an investment point of view, then technically there's only 2 goals here, right? We don't really need to care about all this fancy stuff. We don't need to care about location, facing, view, floor level. All we want to do for investment point of view is to have these 2 objectives met. First, it must have capital appreciation. I want to see my property make money. I don't want to see my property lose money. Second of all, this is something that a lot of people always leave out. It's the ease of exit. You want to make sure that you buy something that has strong demand in the future. You want to make sure that this particular product has future proof, right? 5 years later, 7 years later, if you want to sell, can sell or not. If cannot sell, don't buy, right? Because that's going to completely cross out this entire investment analysis checklist as well. So 2 key criteria which really must have. You are coming purely for an investment goal. One of it don't have, we don't bother buying for that private property or rather the investment journey. So of course, for every home, especially when it comes to like needs analysis, there's no 100% one, right? There's something that you're going to give and take. There is something that maybe you have to compromise. But I think you have like 80-90%, you're almost set there already. So you also need to prioritize the order of importance as to what's important for you. Sometimes people, location is more important than floor level. Then we focus on location first, right? So we have to understand the priorities. And if we can combine these 2 concepts together, your needs analysis plus the investment analysis, of course, that would be the 100% best case scenario together with the most comfortable financial range. This would be like straight go ahead. We can move forward already. And so I think if let's say we can't, we have probably to compromise a little bit here on your needs analysis, but still ensuring that, then we can do something called the concept of stay vesting. So we hear a lot about investing, but if let's say you plan to sell your HDB and move collectively under like one single household, means 2 names go into the next home, then we want to introduce this concept of stay vesting, whereby you still get to stay in this particular property, but we ensure that this particular property selection has been done right, so that it meets that 2 objectives, capital appreciation as well as ease of exit, while still allowing your family to stay very happily here as well. So of course, I think that, you know, when you want to sell and buy, there's always this very emotional aspect to it. You know, sometimes we cannot bear to leave the first home that we have bought into, or maybe for the next home, we also have certain emotional attachments, like emotional feelings that, okay, I definitely want to sell, stay only in the east side, I do not want to move to the west, but maybe in that season, the west has presented better opportunities for you also. So sometimes if we are coming from an investment point of view, we do also want to ensure we can remove all these emotional aspects and to see things from a bigger picture. And I think you also have to understand your eligibility if you are planning this entire round. You really want to know whether you have MOP, because even if let's say you want to buy a new launch, today you're in your 3rd year of your BTO, staying inside already, you still cannot apply for a new launch. You have to wait for your 5 years MOP before you can apply for your next home. So it doesn't mean that even though the new launch is going to complete 4 years later, you can apply for something now. So that's something to understand here as well. You want to understand like your loan IPA, whether you guys will be hit with any ABSD, any restrictions on the next home. For example, like land that is only available to Singaporeans. If you are a PR, you will need LDAU approval to buy a landed homes also. So things like eligibility should be clear check as well. Moving on to finances. We will not go too deep today, but this is basically the checklist that you need to do on your own, or feel free to consult your real estate agents as well. They can also help you with this. Check out your sales proceeds from your current BTO or your HDB. How much can it sell? What is the outstanding loan? What's the amount of CPF usage used? So that we know what are the cash proceeds that's coming out from there, together with the CPF usage, and therefore you can determine your purchasing affordability. Check out your bank loan capabilities in the sense that go and do up your bank IPA. Know exactly how much you can loan for how long as well, and then work backwards to see what's the max range that we can go. And in terms of the max range, is the monthly installment comfortable? If the monthly installment not comfortable, we have to rework the numbers, tweak it a little bit so that everything makes sense as well as a whole. CPF usage allowances, sometimes you're buying into older property, you may not be fully able to wipe out all your CPF, so things like that we also want to take note. Cash components needed, 25% is the minimum down payment needed, 5% for any loan is the minimum cash outlay. Do we have that in cash already as well? So all these are things to take note as well. If you need a very quick help also, just feel free to head on to our PropertyLimBrothers Tech Tools web Tech Tools under the Tech Tools tab. There are a lot of calculators for you to play with over there. You can calculate your sales proceeds, your affordability, your TDSR, your monthly income, so on and so forth. So use that to go and check out your finances. If not, speak to someone who's a professional as well. And I think when it comes to portfolio planning in finances, we have to understand all this first here as well. Next home, are we buying under one name, under two names? What's going to be the better route? Are we going to buy two properties or one property, one big one small one, maybe one small plus one big? What is the route that are we taking forward, and what's probably the best case for your own family needs as well? Any restriction or any ABSD to take note of, because if the property portfolio was not done correctly, you might be hit with ABSD unknowingly also. And maybe if you guys plan to hold one property under two names, do you want to have plans to decouple in future? If that's the case, then you also want to be very mindful of the percentage of housing right from the start, because the moment you buy into it, you cannot change. You want to change your property percentage holdings halfway through is a complete new transaction again. Alright, but one thing to take note, if you're buying under one name, only that person's name, that person's CPF, and that person's income can be considered for the loan capabilities. So that's usually one of the biggest consideration as well. You cannot use your partner's name even though he's not inside, or his CPF to finance the home. And I think same, we talk about exit plan, always think about your exit plan. Are you going to decouple in the future? Because if you are, the planning needs to be done even more thoroughly right from the start as well. So assess your loan, assess your age, your income, and this is something that I love to do for my clients, and I think this helps clients to see very clearly what's going to happen in the long run. So what we want to take a look here is, if let's say you have shortlisted a few projects, I want to know what's the 99 years lease starting from. I don't really care about the TOP date, right? Because TOP date is the date that you can move into, or rather the project has met its TOP, is when it's completed. But most importantly, what we're always buying into is the number of lease left. So I want to take a look at when the lease started. And then I want to work backwards. As of today, 2025, what is my remaining lease for this particular project? And I also want to take a look, today, let's say I'm already 49 years old. 3 years later, I'll be 52, 55, 56. So this is going to give you an understanding as to, let's say 5 years down the road, can you still loan? Will you still be working? You have to think about that. And maybe 5 years down the road, how old will your property be? So do you want to then go into something that is newer, or do you want to go something that is older? Right? So these are things that we also want to cross-check to better understand the market and better understand our time horizon. So step 3 is timeline planning. So timeline planning, when do you start selling? When do you start buying? There are a lot of questions here, sell first or buy first, because one route is going to give you flexibility to buy something that you love, but in that sense, you're going to have a lot of pressure to sell because you have already locked yourself into the next home. Maybe you only have 2 or 3 months to sell. Are you confident to sell a house? But if let's say you don't sell first, but let's say if you go and sell first, then you got no ABSD. But if you go and buy first and you cannot sell, you'll either be hit with ABSD or you have to forfeit your deposit. So these are very crucial things to think about. This is usually how a typical timeline will look like from a HDB to a condo, and this is what we call like a back-to-back sort of transaction, whereby we take up the full 3 months extension and we can avoid ABSD here with the right planning, moving into the next home concurrently without having to go out and rent. But of course, this takes planning. So speak to your realtor, because this one needs like individual sort of level. We really need to assess what is your current sort of comfort and where your current timeline is, what are the finances we're having. And because if let's say we need the entire sales proceeds to come out first before we can place out an option for the next home, then we either have to do like something like maybe a bridging loan, or we have to shift this entire timeline backwards also. So this whole timeline is extremely fluid. A lot of things can change. It really boils down to your own personal needs. Things to ask yourself when it comes to timeline planning: do you have the funds, to buy the next home before you even sell? If you don't have, then likelihood you need to sell first, right? Do you need a full 75% loan? Because if you didn't know, if you went on to buy first while still holding on to your current property, your LTV is going to drop below the 75% mark. It's going to be at 45% for a second loan until you have sold off this property. So we also want to understand whether we have enough down payment to top up for the remaining LTV shortage. Do we have names now? Because if let's say we don't have names, we need to pay ABSD if we want to buy first. So how are we going to structure that as well? And of course, sometimes maybe the next home that you're buying needs a complete gut renovation, and the amount of extension that HDB allows is 3 months. It's not enough. If that's the case, then we might also need to start planning for a rental or a transition home as well. So all these things are things to ask yourself. But in summary, these are some of the considerations if you are selling first or buying first. Feel free to take a pause button here. You can slowly read on your own time. Similarly, these are some of the pros and cons if you want to buy first versus whether you want to sell first. But basically, my advice is that if let's say you are someone who's a bit more fearful into like there's nothing to buy and you don't want to sell unless there's something to buy, it might be better to think about buying first. Right? Because you make sure that you lock in something that you like before you start to sell. And at least in that sense, you have something, you still have a current home to stay. But whereas on the other hand, you're very fearful that, or you already know that perhaps the current property you have is very competitive, it might not be easy to sell, you don't know how long it takes to sell, it will definitely be safer to go for the selling first route. Ensure that is sold out first so that you're free of ABSD, you cash out all the funds that you need from there before you transition to your next home. Okay, so ensure your timeline planning is done well to avoid all the kind of stressful and painful transitions for your loved ones, because sometimes if it's done wrongly, and we have seen it many times on the ground as well, what's going to happen is that you might end up with more costings involved because you have to go and rent, or you have to go and like delay your renovation, or sometimes we have also seen clients that come to us, they have already placed an option for the next home right from the start, but they did not know that they will be hit with ABSD. So in the end, they scramble for time to sell the place. Sometimes it's not possible within that period. They in the end have to forfeit whatever deposit they have placed, they have already put in for their next home. So it's quite a painful journey as well. And I think a lot of people also ask this: should I wait for the market to drop? In the sense that, should I wait for market pricing to come down? Property price maybe will come down, should I wait or not? Right? Or should I wait for interest rate to drop? Maybe interest rate come down lower, then my financing is more affordable also. But I think the key thing here to take note is that if you are upgrading, so if you are thinking about upgrading, I will never ever suggest you to time the market. And why do I say so? Because there's actually more opportunity cost involved for you as a homeowner today. If let's say you are currently in a condo or even a HDB worth about $1 million, let's say $1.5 million, versus something that is of a stronger, and you're planning to move towards a stronger asset, a 4-beta of a bigger size, every 100 PSF increase is going to balloon up a lot faster in the bigger property versus the smaller property. So every time you're upgrading, even though this might have moved up, you might still have seen 120K gains here, but your bigger property, your target property will have moved up by 400K. So effectively, you're still making a loss here, rather a loss of opportunity cost because you choose to time the market. So if anytime you're planning to move to a stronger asset, try not to time the market, because especially if in the uptrend market, you will probably have more to lose than more to gain, right? Similarly, coming back to this also, if you're moving to a stronger asset, whether it's a condo versus a landed, it always makes better sense to not time the market, to move in the stronger asset as soon as you can, because you want to position yourself ready. If let's say the market really continues to pick up very, very fast, then at least if you're already in a stronger asset, you have nothing to worry about, rather than if let's say you are in a weaker asset, or let's say in your condo, you're already planning to upgrade on your HDB, but because you choose to time the market, 1 year later, you might realize that you have been priced out of certain category of homes as well, especially if it's in a bull market. However, on the other hand, if you are downsizing, you are right-sizing, you are going to something of a smaller quantum, smaller size, now of course, the best case here is to stick to your price because you have no urgency. Even if in an uptrend market, your property will move faster than the smaller property. So if that's the case, then stick to your price. You can try to time the market here as well. well. But as long as you are upgrading, then we do not suggest timing the market. Okay, so this is similarly sort of like the growth opportunities and the opportunity cost if we have chosen to time the market. Assuming a property value at 1.75 versus something that's 4.5, everyone grows at 3% per annum. You'll realize that if we have stuck on to 1.75 instead of upgrading, we have made a difference, a loss of $2.8 million just in the first year, and we move all the way to end of the 4 years, it's over $3 million in terms of a delta difference for the opportunity cost here as well. Really, once again, try not to time the market because there are growth opportunities involved, especially if it's a bigger quantum or if it's a bigger size kind of property here. So moving on to this segment, so this is a very interesting one. So this is really all about micro selection strategies, how we help our client make the best decision what to buy, whether it's TOP projects, whether it's condo projects, whether it's a resale market. So coming back to this again, we want to remember every project that we select must have these two key factors. It must have capital appreciation, it must have an ease of exit as well. So these are like the many frameworks that we have at PropertyLimBrothers to help our buyers make a sound decision as well. So all these frameworks, I will just dive through some of it here very quickly for you guys. So we have the PLB mode analysis. Basically, the mode analysis allow us to score a certain project, giving them a scoring based on different kind of categories. So we have like the quantum effect, parents attraction effect, the exit audience, as well as the volume effect. I'll touch more on some of the key ones. So for example, the volume effect later on. So first of all, this is also another framework that we have here. We always want to identify what kind of product am I buying into, whether it's a high appreciation potential characteristics home or whether it's not. So we have categorized them into Q1, 2, 3, 4. So we have low growth, high rental yield, low growth, low rental yield, or homes with high growth, high rental yield, or homes with maybe high growth, low rental yield. And very likelihood, these are the kind of category of homes. And of course, we also then put a styling to them as to what would be the better buys. So of course, if let's say it's low growth, low rental yield, Q1 kind of homes, just 1 star, try not to buy because I don't see any benefits coming here. It might be better off for you to do your own investments outside. If it's a low growth but high rental yield, maybe you can still consider. But personally, I will only go for Q2 or Q1 kind of homes, at least a 3-star or 4-star kind of homes. High growth is important because the capital appreciation will always outrun your rental yield, especially here in Singapore property market sector. So these are the 2 categories of homes that we always want to look out for. So when you are selecting certain projects, we want to understand where does this particular property fall into this quadrant here as well. And so let's move on to this one here. I'm going to show you the volume effect which I talked about. So the volume effect is very interesting. This is Marine Parade for you, for those who are not too familiar. Marine Parade is here. I'm going to show you Silver Sea. It's a big project here, 99 years. Versus Aristo at Amber, just across Silver Sea. Of course, that is a boutique development. So the volume effect basically wants to clock the number of transactions. Basically says that, the bigger the entire project volume is in terms of the number of units, the better buy it would be. So let's see how it takes shape, right? So Silver Sea has 383 units versus Aristo at Amber 56 units. Aristo is freehold, right? So technically that's more premium than this 99 years. But if you take a look at the transactions and how it has been doing, so on the left, this would be for Silver Sea. You can see for Silver Sea, the profitable transactions are ranging from like 730K all the way up to $1.8 million for their top 20 versus the Aristo, 410K all the way to 960K. So still profitable, but you can see that even though this is a freehold, that is a 99 years, the profitability has doubled in this particular project, largely due to the volume effect because there are more number of units, the transactions are a lot more healthy, it is clocking on a regular basis versus something of a quieter sort of development, lesser number of units, lesser transactions, and that's also why maybe the pricing appreciation does not happen as fast. So similarly, I'm going to show you another one. These two, Amber Park and Coastline Residences. Amber Park has 592 units, Coastline 144 units. Both are freehold, both actually TOP back about the same time, both launched about the same time. So buyers technically had options to go whether they want to go Amber Park or Coastline Residences. So you can see they both, in 2019, they were doing about 2.3 to 2.5 odd PSF. So you could have either gone for one. But coming back today, 2025, Amber Park has 50 profitable transactions. Profitability ranges from like 320K all the way up to 820K. On the other hand, for Coastline, they TOP back about the same time. The number of transactions is only about 8. So once again, the volume effect is very evident here. Number of transactions is slower, number of transactions is faster. Profitability, this is from like 9K all the way up to a max of 462K. So once again, Amber Park has like outperformed Coastline Residences, even though they have like similar sort of tenure, they have similar sort of age, but the profitability has ×2 over here because of the volume effect. So this is something to take note of as well. And I think most importantly for pricing, we always want to understand this. whether there's a pricing disparity, and we want to take a look both at the quantum level of disparity as well as PSF disparity. So for example, in terms of a quantum play, I always want to understand what's going through a buyer's mind today, right? Especially if I'm a seller or whether I'm buying it for my own stay or investment. If at X amount of dollars, I can get a landed versus a two-bedder, of course I'm going to go for landed, right? So there always needs to be a pricing disparity between each sort of category. And in fact, I think some people are not very mindful, but even if, let's say, within a three-bedder category, there are a lot of different tierings here as well. We have three-bedders 99 years, three-bedder freehold, three-bedder dual key, three-bedder penthouse, and then of course before that we move to the four-bedder. So personally, if let's say the pricing for a three-bedder dual key is too close to a four-bedder, I would have gone for a four-bedder rather than three-bedder dual key, because that's going to give me one extra bedroom, give me more space, and of a stronger asset class. So we always want to be very mindful of the micro disparities between each segment as well before we make a selection. So similarly, if let's say someone with a budget of $4-5 million, they will have this dilemma. I can maybe go for a new launch condo right now, 4-5 bedder, 3.5 to 4.5, or should I go for a strata landed? Right? I also can get something from 3.5 to 4.5. Or should I go for a Cat 1 landed here at 4 to 5? So the moment we have this a little bit of sandwich class, the strongest asset class is going to propel even faster in the longer run. So this kind of disparity is something that we want to be very mindful of as well. And for buying power triangle, basically there are more buyers at the bottom because the quantum is a lot more affordable. The moment you move up to a higher buying power triangle, usually the number of buyer pool is going to be a lot lesser. So that also means that you either have to have stronger holding power, or you want to be very mindful when you want to exit. It's not going to be like your mass market sort of quantum properties as well. So then the question always come here as well, like, hey, should I buy new launch, TOP project, or resale today? Which one is the best to buy, right? So my answer to you is this: there's really no one right answer. We are really looking for disparity effect, right? So every season has its own kind of property portfolio that does better. So we want to hunt for that kind of pricing disparity in that particular season, rather than telling you like, oh, okay, you know what, just buy new launch, confirm make money. It doesn't work that way for us, okay? So why some people love to buy new launch? They have like first mover advantage, herd mentality, brand new conditions, so on and so forth. Everything is brand new. Some people love TOP projects because it's also brand new and you don't have to wait for it to build. So usually there's a pricing premium for this kind. You still have quite a healthy list. Some people love resale because it gives you better floor plate. It's a lot more affordable. Usually it comes with the trifecta as well. So when we're talking about how to choose, like just now what I mentioned, we try not to sort of just say that new launch is the best way. We really want to identify in that particular season what would be a better buy. So this is another case study. So this family here, we have also helped them to sell off their BTO, move to another three-bedder condo, move to a four-bedder penthouse, and right now they are in a four-bedder RCR region. Total portfolio is about $3.1 million. But the key question here was that previously they had the option to either buy one of these. They could have gone for riverfront residences, brand new launch three-bedder, or they could have gone for Real Vista resale. So let's take a look at how we have decided to help this family plan for their portfolio. So riverfront new launch, they have bought something maybe about $1.26 million. Fast forward to today, or rather in 2024, it has still done very well. 300K in terms of profit, so they were still seeing healthy profits if they're gone for this new launch. Right now it's doing about 1.5, 1.58. But our answer to them at that point was that, hey, I think that you all should go for Real Vista penthouse. Go for the resale unit. Let's take a look at how the three-bedder penthouse at Real Vista has performed. So back in 2020, they bought about 1.5 plus. So in fact, you can see that from between 1.2 odd to 1.5 plus, they would have entered the resale on a higher end versus the three-bedder for a new launch. And why they decided to follow our advice is because of this. Because the size is so much bigger, we also noted a disparity effect in that particular season. We saw that the resale market had a lot of room to grow. True enough, 4 years later, they have successfully sold off this particular penthouse here already at $2.42 million, 855K profit across the 4 years. So 855K versus 300K, they have made more than more than 500K in terms of gain just by switching into the resale market, but of course just through the right selection strategies as well. So this is what we are talking about. We always want to pair it. It's not about what exactly to buy, but in that particular season, we want to pair whether it's a TOP with OCR, whether it's a resale with RCR, understand the different kind of pairing strategies in that particular season. We want to spot opportunities. We want to see the market as a whole. Are there opportunities that's going to rise in different areas as well as different kind of product types? So this is the trifecta we're talking about, and I think a lot of people, a lot of people don't sort of visualize their exit plan, especially if they're buying new launches, because there's so much hype on the launch day, everyone gets so excited. But it's really important for you to think about the longer run, about the exit audience, rather than buying just based on emotions. Right, so buying is easy, but selling is difficult. You only know how good your property is when you're trying to sell. And I think the moment that you're bought into something that is not going to perform as well, maybe it's going to stagnate, then this is what's going to happen. You will have wasted 10, 20 years sometimes before your property start to perform better. And if it's a stagnant property, you're going to waste opportunities as well during your highest income producing years, which can then limit the amount of options or the amount of time that you can continue to sort of 2x your property portfolio. Alright, so we also have this investment analysis framework, very helpful, especially if you're looking for resale or new launches. So for example, this one here is also at Emerald of Katong. There was a new launch. What we term this framework is called the double catalyst PSF push, so the DCPP method. So what has happened here is that this has done extremely well, right? Emerald of Katong sold off very, very well. But the people here around, all these projects like Head Court, One Amber, as well as the Esther, has also stood to benefit very greatly from this new launch. So this is what has happened. Emerald of Katong launched at 2006 odd PSF. Previously at that range, One Amber was just doing about 21 PSF, Head Court 2002 odd, 2000 odd PSF, Shaw Residences 2000 odd PSF, and Esther 2002 PSF. Then once Emerald of Katong did 2006, everyone sort of increased their asking price, right? All the home sellers now are like, hey, I'm freehold. This new guy here is 99 years. We are in the same area. I'm freehold. I have a premium. I'm going to increase my asking price. All of them started to call for a lot of a higher pricing. So they added a 200, 300 PSF in terms of their push. And then fast forward, what's going to happen in year 2028 to 2029? Emerald of Katong is going to TOP. And of course, once they TOP, they maybe bought at 2.6. The owners here will definitely look on a higher PSF. Maybe right now they are going to ask for like about 2009 or PSF, right? So that's going to be a second catalyst push. That's also what we call as a double catalyst push effect. Because the first round was at the launch before the project TOP, the pricing benchmark was set. All the resale counterparts are standing to benefit from it. Fast forward to today, once it's TOP, there will be a second round of another catalyst push. We will also see the prices for the resale performing extremely well as well. And we also have this PLB lease reset calculator to decide whether it's a new launch or whether we should go for a resale condo. We want to reset back everything back to 99 years to have a very equal sort of comparison at the PSF levels to make sense. So for example, in this particular case, it really makes sense to go for Amo Residences, even though the new launches was on a very high end. And I think for new launches, if you're already decided that you only want to do new launch, then these are the frameworks that we will also apply to ensure that the new launch is done correctly. And I think the most important one is always like what we mentioned about to think about your future, think about the exit plan. You want in your exit plan, right? Basically, there are these 5 factors. First of all, ask yourself, does my buyer have a lot of options to choose from the area I bought in? Is it a highly competitive area? If it is, am I going to be able to stand out from the competition? Am I going to be able to exit in the future? Second of all, you want to ask yourself, does the buyers have that kind of affordability in the area as well, right? So especially in a new township where there are more HDB, is actually good because there is an exit audience, you have more demand, and most of the time your strongest upgraders are going to come from the HDB because they have profited from their BTO as well. So for example, the number of $1 million HDB transactions has risen very greatly over the past few years. We've seen that especially in the mature townships, Bidadari, as well as the Kallang, Whampoa area. We also have like Clementi homes as well. This is an example of the exit audience effect. So for Woodlane Residences, as well as Park Colonial, earlier on, if you remember, they did very well in terms of profitability. They also have a very strong upcoming exit audience that's going to be able to buy into the surrounding areas. All these owners here have easily doubled up their BTO profits also. So exit factor 3, are your audience more of home buyers or investors? So this also depends on the type of product that you buy. If you're buying like maybe a 1-2 bedder, likelihood more often than not, you're going to get quite a fair bit of investors as well. But if let's say you're going like 3, 4, 5 bedders, then usually the kind of audience is going to shift more towards the own stay audience as well. So you want to know what is the mentality behind all these kind of buyers and how that's going to affect you as well. Parents attraction effect. This is really more for like the primary schools within the 1 kilometer mark. Singaporeans love a good education, so a lot of people do go quite crazy for a good primary school. So you are placed within good primary schools. That's also going to help to elevate your exit plan. And of course, the last one, always have a look at the master plan. Understand what's going to come out in the area. Is the empty plot in front going to be redeveloped for housing, commercial, industrial, what's going to come up next, whether this particular township has room to grow or whether this particular township is done in terms of like land supply. Nothing else. You have to wait for spillover effect from other estates as well. So transformation is another key thing to take note of as well. Right? So I think like what we mentioned, you only know if you have bought a good property the moment you're trying to sell it, because the moment you're trying to sell it is the true test of time, whether there's enough demand, whether there's enough offers that are coming in for it as well. So the last step of the framework was to correct a set at the correct entry price. Basically, by this stage, after you have done all step 1 to step 4, you have understood your true finances, your timeline, what would be the right sort of property area, districts and product type to go for. Then you go and offer up for the right unit at the right entry price. Of course, for entry price, I think you really need to do a lot of in-depth research first as well. Understand all the key frameworks that we talk about, like especially your disparity effect. And then if you have done the selection correctly, what's going to happen that you're going to help to exit speedily next time in a bear market. Even if the property market is not going to do as well, or maybe it's going to take a slowdown, if it's in a bear market, at least you'll be able to safeguard your exit plan, right? But of course, if it's in a bull market, that's going to help to accelerate your entire profitability a lot more. So pricing entry is really an art of understanding the past, the present, how the current market is doing, and what are the potentials of the area. Because sometimes it might be worth paying a little bit more of a premium for that particular unit versus another project that has like undervalued buys, because maybe project A is going to give you much better returns in the long run as well. So things like that really needs a lot more study. You need a lot more, need some level of experience as well to understand the area. Alright, so just through good research, your core fundamentals, I think that you can make that sound decision to have that correct asset at the correct entry price. So basically, to sum up, this would be your 5-step framework. So first of all, let's go back also, it's your direction. Second of all, understanding your finances. Thirdly, your time frame. Fourth is the most crucial one, knowing the right strategies to identify what are the good properties in that particular season. And of course, naturally, then the last step will come in place, find the right property, offer up at the right price, and then you're set to go as well. So I think that's all we have for you today. So we hope that you have taken some insights from today's session. I know it's quite a little bit of information throughout. If you are planning to upgrade, maybe you need a little bit more help about your finances, you want to understand how to structure your portfolio correctly, and you want to have a personal chat, feel free to reach out to any of our teammates here as well. We'll be more than happy to schedule like a non-obligatory consultation for you as well. If not, that's all that we have for you today, and we hope to see you on the next episode.